Wouldn't it be a great thing if we all had a crystal ball and we could look into it and determine what's going to happen in 6 months, 12 months, 5 years from today? The oil and gas market and the oil and gas industry is a global industry. Every user, every country, every manufacturing resource, every utility company, to some degree or another, utilizes fossil fuels. The great majority is based on oil and gas. Now, when I think about trying to ascertain or analyze where the oil and gas industry goes from today forward, I have a lot to consider. I got one of the largest producers in the world, Russia, who's been at war with Ukraine going on 5 years. There's been sanctions. There's been redirection. There's been exploration. There's been monetary shifts and changes in the value and the income derived based on the price of oil over the last 4 years for Russia. We then take a look at the current war with the United States and Israel against Iran. And we see the calamity that's been created at the Strait of Hormuz. It's a unique, very distinct event. No one, I don't think anyone in the war room, economist, anyone in the industry had any idea that we'd be dealing with that strait being shut down for 90 days. And I don't think anyone calibrated the downstream effect of what happens to all the supply, the logistics, the orientation, and the complete shortage of supply as a result of that one single strait of water no longer being accessible on a daily basis, moving cargo ships and crude oil. So today, I listen to all these other analysts, and they all think they have this expertise, and they all think they know what they're talking about. As a fundamental oil and gas expert for 41 years, I'm the guy in the trenches every day, and I'm looking at what I pay for cattle guards and equipment, what I have to pay in tariffs to move gas and oil to the market, what the labor looks like, the cost of steel looks like, wellheads look like. We also have hedging on some of our accounts. We have the ability to look at capital, the cost of capital. We look at the very fundamentals here in the country, United States. We look at the fundamentals of what it takes just to secure the right to explore for oil and gas, whether it's on state lands, university lands, federal lands, or private oil and gas mineral rights. To get a crystal ball and try to determine financially and with capital deployment where the globe is going, I think there's very, very significant and probably critical industry changes that are taking place today. Why? Oil and gas is about economics. It always is and always has been. For 50 years, they talked about peak oil. They said, we're going to run out of oil. We're going to run out of oil. That was been on the books since I started my career in 1985. Then that flipped very carefully to, we're not worried about peak oil. We're worried about a glut, too much supply. Literally 5 months ago, major banks were talking about we're going to have a glut for oil and oil is going to plummet to $40 a barrel. Now, see, that was information, in my opinion, based on absolute ignorance of the market. Now, don't get me wrong. If oil prices, crude oil prices across the globe were to exceed, say, $90 a barrel, and it looked like the runway, the forward market value for crude oil stayed above $90 a barrel for the next 5 years, we probably can pick up another 10 to 20% of daily production, but it's going to come from areas that it requires that higher price oil to justify drilling, completion, and delivering that crude oil. In other words, it's all about economics. If oil prices are $65 a barrel and Iran can produce oil at $8 a barrel, they got a pretty significant advantage over the United States, who on average might be at $60 a barrel to break even. Let me repeat that. Maybe we, as a producer, the largest oil producer in the world, the United States of America, if we average $60 a barrel to break even, to pay for cost and royalties and production and expenses and the movement of our oil to market, $60 a barrel, and Iran's at $8 a barrel, they've got about a 7-to-1 advantage over us. The only differential between us and Iran, for the most part, is they need that oil because it runs about 65 to 75% of their entire economy. They don't know what they would do if they could not deliver oil. And I believe that's why President Trump, who was begging and threatening to open up the Straits of Hormuz, finally conceded and said, they're not listening. The Iranian, the Republican Guard, the terrorists are not listening. So I'm going to reverse it. Instead of telling them to open the strait, I'm going to shut the Strait of Hormuz off and not allow the very people that we have been at war with, we're not going to allow them to hold us hostage anymore. We're going to hold them hostage by not letting them deliver and sell the crude oil they produce that economically supports their country. The only problem with that crystal ball theory, and that crystal ball today is trying to predict what oil is going to do for the next week. Is it going to go up or is it going to go down? Everybody wants to know because we have a shortage of supply. There are other countries, Norway, Brazil, Argentina, Africa, Guyana. There's other places in the world that have been working very hard to get oil and gas productive in their countries, and they have a variable difference in what their costs are. And they're all trying to jockey for position, saying, how do we participate in a global supply, knowing that we have a very large stronghold in the Middle East between Saudi and Dubai and Kuwait and all the other Middle Eastern countries? How do we measure the cost of what we drill and produce compared to differentials that swing from $32 a barrel to $145 a barrel? It's a radical change in economic fundamentals. So today, the crystal ball is, do we have a situation where Iran can actually sit there and say, we don't care if you shut in the Strait of Hormuz? We can live a long, long time on very little oil sales by crunching and squeezing the economy inside of our country. Can we reroute some of that oil by different means like truck or rail or anything else, not actually rail, but truck or pipeline to different areas and ports that we can get around the Strait of Hormuz and the blockade? Do we have to shut our wells in, or do we have enough storage we can last for months and months and months by just simply reducing the flow rate of our wells at the wellhead and allowing ourselves to still make our wells viable, but we cut them back enough we don't have an overflow without having storage? There are major decisions being made in the oil and gas industry. And so I like to say, what does it look like post-war with Iran? What does that scenario look like? What does the crystal ball tell me? But what it tells me is there's going to be a lot of money, a tremendous amount of capital. We're talking billions of dollars that are going to be reallocated and investing in other areas besides the Middle East. They're going to go invest in Africa. They're going to jump in the Vaca Muerta field down in Argentina. They're going to participate in Brazil. They're going to look at Guyana. They're going to look at other parts of the world that are not going to be ever directly affected by a hostage situation like shutting down the Strait of Hormuz, because they can't afford that to reflect on their own economies for their own countries. If that's true, at what level or what price does each one of these alternative oil supplies require to make economic sense? And then the second part is, what happens if, in fact, the Middle East says, wait a minute, we lost a tremendous amount of market share during this whole debacle and this whole war. How do we get that market share back? Well, the best way to do it is run your neighbor out of business. How do you run other oil-producing countries, other oil-producing basins? How do you get them to become uneconomical? You flood the market. You take Saudi, and Saudi says, we've been making 9 million barrels a day. Let's crank it up to 12, because our break-even cost is $8 or $9 a barrel too. If Iran can deal with sanctions and they come out of this war with some kind of right to produce their oil, they'll crank it as high as they can because their break-even is so much lower than anybody else's. In the entire Middle East and the OPEC as it exists today, the UAE who just broke away, they're all going to say, I can produce 1 million barrels at $100 a barrel, or I can produce 4 million barrels at $60 a barrel, but nobody else can produce that much oil at that lower price. They will flood the market. Is there a true opportunity you could see oil prices drop back into the 40s and $50 a barrel? And I'm going to say that depends. Although I don't have the crystal ball, I do have what I consider to be human and emotional factors. And I say, if I put myself in the position of the Middle East and Iran and UAE and the other OPEC members and Russia, I'm going to beat the economic stress of sanctions and punishment and war and changes in flow and logistics. I'm going to beat that by taking what I have an abundance of and pushing more into the market at a lower price, which makes it uneconomical for anybody trying to compete with us. You push oil to $45 a barrel, Vaca Muerta in Argentina doesn't work, in my opinion. A lot of Africa doesn't work. Brazil, it's not making near the money. It's not drilling new wells. You're looking at really stressing the Canadian tar sands. You're really, really breaking the U.S. shale producers. You get below $55 a barrel, not only will you see drilling rigs in the U.S. be laid down, You'll see producers choking their wells back. You'll see a cost of capital. You literally, we've seen it twice before in the last 15 years, you'll literally decimate the oil and gas industry in the United States because we need probably $60 to $65 a barrel. The other side of the coin is, if I don't have a crystal ball, or if I think I can interpret the crystal ball of the future oil and gas post-Iranian war, I got to make a decision. I have to decide what direction it's going to go. I have to decide what's best for me and what's best for my partners and what's best for my decision-making, looking at a 10 to 20-year forward view of the oil and gas industry. See, I don't look at things month to month, week to week. I look at the preponderance of the evidence to tell me, what does the post-Iranian, post-Russian Ukraine war look like in terms of global supply? And what it looks like to me is many of these recent commencements of production, like Guyana and Argentina, they have an abundance of oil. They're going to keep going up. And I believe there's going to be other areas that are going to say at $60, $65 a barrel, we can also make a profit. U.S. producers are going to get squeezed hard. They're going to have to figure out a way to be very, very efficient at lower prices if, in fact, we go back to $55 to $65 oil. Saudi will produce enough to win back market share. But the one major part of the crystal ball that is equally as important as what I just described is demand. Everything we are doing today between artificial intelligence, data centers, manufacturing, redirection on import-export, bringing back to the United States all that manufacturing, we're going to consume more and more oil every day going forward than we've ever consumed before. We're at about 101 million barrels a day today. Key point, 101 million barrels a day that will never be available on planet Earth again. It is a completely disappearing natural resource. When we consume that 101 million barrels today around the globe, it doesn't exist ever again. So we've got a treadmill of having to supply that 100 plus million barrels a day. And by some projections, they're saying we should be between 108 to 110 million barrels a day by 2030. I'm talking 5, 6, 7 million barrels a day increase because of artificial intelligence, human population, manufacturing, and industrialization. If that's true, let's say Argentina does come online with 900,000 barrels a day. Well, we need 7 million. Let's say that Guyana's up to 2 million barrels a day. That's okay. We still have 3 million barrels left. Let's say Norway puts a platform back on. Let's say the platform President Trump issued to come back online off of California stays online. It doesn't matter if you add these other sources. It's not going to come fast enough with enough quantity to offset what I believe is going to be rising demand at exponential numbers that we haven't seen in 50 to 60 years. So the Iranian war, crystal ball, my opinion, we're going to see prices stay fairly healthy, north of $80 a barrel through the end of the year. Could go much higher depending on what happens on the resolution to the war in the Iranian war with the U.S., right? I believe it's still going to stay above $80 a barrel to replenish all the storage and get those soft barrels back into position again. But from a 5 to 10 year perspective, I think demand is going to outrun new supply. I believe you're going to have a lot of financial limitations by certain countries based on what that parameters look like. And I can see the next decade being what I call a lift to the floor, the hard floor oil prices that puts us between $85 and $100 a barrel on average over the next 10 years. The Iranian war, I don't know. It's anybody's guess, not in my hands. Crystal ball, is it foggy? Is it clear? Everybody has a crystal ball. Everybody makes a prediction. Mine is not a prediction. Mine is a business decision in a direction and a summation of where I believe oil is going to go, so I can make investments and decisions and place my money, my capital, my company in a direction that makes sense. You, as someone watching this, will have to decide for yourself where you think oil and gas prices are going to go and how that's going to directly affect those different asset classes you have that are going to be functionally affected by either an increase, decrease in the price of crude oil, and how it affects inflation, recession, stagflation, all the other economic parameters. Thanks for listening.